Go through the
We're
metals presentation.
Yeah, we'll go through that too. Hey guys, we're with the commodity report today. It's me and Sam. Kevin will be doing a different thing from now on going forward for a little bit. We're going to do pre-recorded sessions, put those out throughout the week periodically. So as you see that, I think they'll be awesome, but we're still going to try to come with you live on Mondays. I'm going to be bringing a bunch of guests going forward, and Sam and I will be talking to them. So today, just starting out, let's look at the commodities. And Sam, we've been seeing this commodity, and not to mention, sorry guys, I'm sorry you can't see my beautiful face today. I know that's probably rough for a lot of you, but my video is not working for some reason, so I'm sorry about that. So getting the commodities, which are even more beautiful, because if we're looking at this, Sam, coffee, you just wrote a paper on coffee recently, Sam. Can you talk a little bit what you talked about in that paper and where you see coffee heading to?
Yeah, for sure. So we've been talking about cocoa for quite some time, and coffee is a very, very similar trade. It peaked back in 1977. That was about 48 years ago, and just now, recently closed above that level for the first time ever. So it has resolved a 48-year basing pattern. And how I learned it in technical analysis kindergarten is the bigger the base, the higher in space. And 48 years is the biggest base in commodities by far.
Really?
Yeah, it is. And you saw cocoa had a similar basing pattern, and it resolved that back in, man, was it 2023, early 2023? And cocoa went on to rally hundreds of percent in a very short amount of time. And you see coffee here is it looks pretty extended, looking at it on this chart. But if you I don't know if you have the data that goes back to 1977.
Does TradingView have it?
I think so, actually.
Okay, let's go to TradingView
Yeah.
because TrendSpider does not. So I'll go to TradingView.
Yeah. But no, I think just if you zoom out, you can see that structurally this thing is just getting started, and it could double, it could triple, it could go 10x for all I know. But I think it's going much, much higher over the coming months to years.
So let's look at this very long-term time frame. God, I haven't looked at coffee on TradingView in a long time. So yeah, let's look at, wow, going all the way back, like Sam said, we're just breaking out now. It's just a new breakout. And a lot of people will talk about, the retest that has to happen. I hate when people say that. It
The
always
best
has to
uptrends
retest.
do not retest the breakout level.
Yes, that's the best thing you will ever learn as a trader is you want that to happen, right? Like that's a hope thing. You want it to happen. You want that retest to happen. It's not going to happen because you want it to happen. I bet if I even go to, some candle charts on this, we're getting even higher up here. And look, it did kind of consolidate. So if we go back to let's go back to the other chart now. So if we go back to our shorter term time frame, it actually did consolidate for a little while. This is a long-term chart. If we look at a weekly chart, you see it did turn into a flag pattern, and then it did break out once again. And this level is back to those old highs, I think, in 2011. And so basically, you see this consolidation pattern here and another breakout. Usually this will be about the same move that you saw here. So this move that you're seeing here will probably see that same move before more consolidation. And once again, it's part of the story that we just continuously talk about here, which is the commodity story. Commodities are going crazy. Nobody's paying any attention. I think it's phenomenal to think about today. I was looking at my portfolio and I'm like, we're up today. And that was before, the market started to really rally. But look at, if we just look at daily, what's going on in the commodities market, natural gas had a huge day, up 11%. We have a position in that. Oats behind that. I don't trade the oats anymore. It's a nice contract for new futures traders, smaller account. So if you guys want to trade that, that's something that's a good thing to trade.
And Jason, what is the old saying about oats no?
Uh,
Do
it's
you know that one? Just like
it's people most of the time it goes back to the I don't know the exact saying. I know what you're talking about, but I know it goes all the way back to the fact that when people start trading oats, it usually means they're broke.
uh,
And because the contracts were small and they could trade them, it's very easy to trade them because you didn't have to have a lot of margin to basically trade it. So basically, anybody who was trading oats was broke. I think that's kind of a ridiculous way of looking at it. I think futures is a very expensive market. Not to mention nowadays the prices are much different than back in the day. Back in the day, you're talking about trading oil. These were the few full size contracts, so there wasn't any minis, micros, anything like that. So people who wanted to get into futures who didn't have the exact amount of money to trade the big contracts would trade things like oats.
well,
And
I
going
kind
to,
of understood it to be like oats are the leading indicator.
oh, really?
They
Hmm.
lead, I don't know, look at products like corn or wheat. You overlay the two, and you see oats tend to lead the way
Lead
higher
the
and
grains.
lower.
Yeah.
Yeah,
That does make sense, and I could see that being, because of the way how they're shaped in the world. Not to mention, if you look for the demand of oats rising during recessionary environments, that's another thing. And usually, coming out of that recessionary environment is where we see that inflationary environment, or at the end of an environment, heading into kind of a recessionary environment. So that actually does make a lot of sense. Um, and looking at wheat today, speaking of another grain, like Sam was talking about, we got wheat up to 2.5%. Lumber's up over 2%. Corn's making a big move. It's been making a big move all year long that nobody's talking about or paying attention to except for us on here. Soybeans, it started to bottom and reversed higher. Gasoline right behind that, up 1.5%. Heating oil has been moving all year. It's trying to start a new uptrend once again. Coffee up 1%. And then let's go back to the year to date again. So we got coffee up 20% year to date. We got soybean oil behind it at 15%. Palladium, something Sam's been talking about a lot. You've been liking palladium this year, Sam. What are you thinking about this palladium market?
it's looking amazing. If you can pull up like a short-term chart, you've just had you broke a downtrend line, you ripped higher, and it's consolidated again, and you're beginning another rip higher phase, So I think this one has 2,000, 3,000 written all over it. This is just the bottoming process, and once it resolves this, you know, the prices can go much higher than people expect.
And yeah, and so if we also take a look at the commercial positioning, we had the record commercial positioning of all time for palladium happened this year, or sorry, last year. And so we saw that record. We saw a rally out of that, meaning a lot of short covering. A lot of the hedgers who were continually buying ended up coming back into it. And then you saw a little rip rally. Came all the way back, and now it's trying to carve out this base again. To me, Sam, this really looks like this is a base.
For sure.
And
And
this
I
is a
think it
base getting
resolves
carved
once
out.
you get the commercials to flip net short once again.
Yes, and,
Uh,
and the second, and it's already coming. You're
right.
looking at this. It's already kind of going the direction you're talking about. So now it's just a little bit further, and this could be a rip roaring rally that really sends palladium into a major uptrend. And we haven't seen it. This thing trends, and a lot of people don't know it or talk about it. I mean, look at 96 to 2001. That's a massive trend, and a lot of people wouldn't think about it. But that's not from the $500 to 1,000. That's from I think that was, what was that, $40, if I remember correctly. Do they have? Oh yeah, there we go. There's the data. So $100, 115, $90, all the way to 1,064, 1,100 at the top. Another rally, about 200, 168, all the way to 896. So, these are like not small rallies. These are 10x, 4x, rallies. And then we have the mother of all palladium rallies, which happened basically from 2016 all the way to 2021. And that was 442. Well, I mean, we could go to either high here, going to the major high, 3,426. I mean, these things move, and I think a lot of people just they don't pay attention to it. And I think that's the thing. The thing I'm trying to portray all year long, in everything I'm writing, everything I'm doing. is just kind of putting forward this notion that, hey, we're in a reflationary environment that is bordering stagflation. And because that environment looks this way and we're bordering stagflation, we should absolutely be in some of these commodities and commodity based sectors and commodity based stocks. And people just aren't paying attention to it like they should.
Yeah, no, you're totally spot on. Palladium to me is just like I don't know, if you like gold, you likely are to like silver. And if you like silver, then why the hell wouldn't you own platinum and palladium? They're just it's just a junkier trade, you know? You get 50% in gold in 12 to 16 months, and you can likely 2, 3, 4, 5x that return with platinum and palladium.
I got to go back to that chart that I tagged you in. Let me try to bring that up here in the chart deck. Rick, what's up, Rick?
Slick Rick.
What's up? How you boys doing?
Good.
Good.
So Rick's here. We're gonna go through some of Rick's stocks in a little bit. Started out a little bit late, Rick. Sorry I didn't get to mention that to you. But I'm gonna try to bring up something from my. We're gonna go through the metals report because we didn't really get to go through much of that at the event. So, and also I wanted to bring up one more thing real fast, which is this chart that I was talking to Sam about. I tagged Sam in this yesterday because it's just really spot on for everything we're talking about here, and it really has to do with the way we're going to see precious metals move in the future. And I think that's something that everybody's curious about right now, because precious metals, if you're looking at the year, I mean, that's then your safest bet. Volatility based, yeah, some things have made some more money, but volatility based, it's been a smooth move for the entire year so far. And if we look at this chart here, whenever it comes up, there we go. We're basically looking at the silver price and the gold price. And I tagged you in this, Sam, because something to me was just sticking out massively this entire time, which is the fact that silver moves last. And you and I have talked about this. We know this a million times. But how do we illustrate this well? And this chart really illustrates what we're talking about. So if you're looking at silver here, you're seeing that, gold might start to move up and be the steady uptrend, and silver kind of might be moving down or sideways, and kind of struggles for a little bit, and then it rips. And you see that every single cycle. So the interesting thing to me is this, and this is what I wrote about on Friday. I'll put Friday's report in the description when this is done. But what I wrote about on Friday was the fact that when you see these type of environments where we start to move into hey, we have gross overvaluations, we have this environment where some of these stocks have continued up much higher than you would ever have dreamed of, and there could be a rotation happening into other sectors. This is usually where you see gold really outperform silver, the massive outperformer. And so if you look back at that happened with the Nifty 50 stocks in the 60s, these are companies like IBM, but also companies that are now defunct like Xerox. So if you're looking at those companies, basically they said, just keep buying those, you'll be fine, everything will be great. Then there was a recession / stagflation / basically a depression through the 70s, all the way to 82. What happened to gold through that period of time? Well, it was gold's best run in history, but also silver had a much better run, massively outperforming that. Get into the 2000s, the 90s even. Let's start in the 90s. The 90s, you have the dot-com bubble. And basically you have dot-com stocks, tech stocks just going up like crazy. Same thing. You've got companies that we have today like Apple, but you also have AOL and all these companies that don't really exist anymore, at least to the same fashion. And then you see gold starts to move, and then silver starts to move. And we see this massive run in gold and silver once again. Same thing, getting into right before 2020. So, anyways, my point is we're in a very similar period today. Is it a thing where I'm saying sell all your AI stocks, sell all your tech stocks? No, I'm not saying that today. But what I am saying is your bet that gold and silvers are probably going to move higher is probably a pretty easy bet.
For sure, yeah. This is something we've been talking about at the gold rush. quite a bit, and just that. And early in these commodity super cycles, you see gold really ring the bell, and then you see silver catch up 12 to 16 months later, and then after that you see the miners really start to pick up, and then you see the junior miners really start to pick up, and it goes on down the line. It's kind of like the dominoes falling of risk appetite. That's how I see
Yes.
it. And really, you haven't seen those signals of risk appetite really come to fruition yet. So to me, this bull market is really infant at this point. It has legs, in my opinion.
Yeah, and that's to your point on the platinum. I saw you posted a great chart on platinum. We got platinum squeezing, ready to rip to the upside. When does that happen? It usually happens in this type of an environment. And that's to me the thing that kind of I feel like separates me from, just a normal technician or a trend trader, systematic trend trader, is I'm always looking at the environment. Because the environment's going to tell you how you want to be positioned. And I think that's incredibly important. So let's hop through some of the metals deck, because I know people want to hear about what's going on with precious metals. What are we thinking going forward? Because we talk about this a lot at the Gold Rush, and we also know where we're at in the cycle. And to me, I will go long gold, I will short gold. I am a long time bull on gold over the very long term horizon, but there's times to short gold and there's times to be long gold. And looking at the environment we're in, it's a time to be long gold. And I think something that we could start with is this long term cycle. And let me get this out of here. Sorry, guys. Um, so if we're looking at this long term cycle, and we're looking at a 40-year uptrend in yields. People don't believe when I tell people about this without showing a chart. People have no idea. They believe they almost talk to me like I'm making it up. There was a huge move in yields all those years ago, basically from what was it, a 2% low in the 10-year yield all the way to 16%. So this is a huge move in the 10-year yield. Also, you had the Fed basically trying to fight the stagflation era in the 70s. And then you get this massive blow off top in 1982. This is why a lot of our parents putting money into retirement accounts with the 60-40 portfolio, they killed it for, 40 years. It was easy money. Stocks went down, bonds went up. So looking forward now, that has completely changed. Stocks and bond, the correlation between them has dried up quite a bit. Used to be when stocks went down, bonds went up. Now they kind of go down together. Yields tend to put more pressure on stocks at the moment because of the way valuations look. This also happened in that era in the 50s and 60s, like with the Nifty 50 stocks that I just talked about. Now we're seeing this inflationary environment. Is it going to be a 40-year move higher in yields? I don't think so. I would be surprised. Now, once again, it
Why do you
can
say
happen.
that?
I just don't think the cycles will always link up perfectly. I think people look to it and go, okay. And once again, here's how I think about it as a trader. How do I think about it as an analyst? Sure, it could be 40 years. How do I think about it as a trader? I don't know what the future really holds, but I know that the trend is most likely higher over the near term next year, and I can reevaluate next year if I saw something that said, hey, inflation's slowing down, or growth is slowing down, something that would put pressure on yields. So for me, there's two different things. I want to be in the trend, but I also want to be cautious here to not get too biased one direction or another. Because even when you look at that massive uptrend, there are periods of time where it does retrace, it does go back the other direction. It could even happen now. We could have yields go down for a little bit and then go higher. My main thing about this is I don't think we're ever going to see the 10-year yield at 1% again in the next 40 years. That's my main thought on this. I don't think we'll see it at 1% in the next 40 years. I'd be surprised if it even hits 2. And so the main thing is it's an inflationary environment, and yields will probably continue to move higher. And so looking at that, Sam, you've looked into this before too, right? Where people talk about the relationship between gold and yields and how it has to go, and they forget that there's been plenty of time where yields have gone up and gold has gone up.
Yeah, for sure. It's not a perfect relationship, but I think just as a general mental model, you can assume that gold struggles in a rising yield environment.
It's rising real yield though, and that's a thing
Yeah,
that we
for
need
sure.
to also say is people look at it and go, okay, what were the rising rates in the 70s, let's say. Well, also inflation was above those rates. So because of that, that makes real yields actually in a downtrend. And it's the same thing that we saw in that period of time in '01 all the way to 2011, which is the same thing. We're seeing real yields were falling, inflation was starting to move up just a little bit. And even though the trend is down there for the U.S. 10-year yield, real yields were still outperforming that. So inflation was outperforming the yield. And so getting to where we're at today, it's the same thing. We're seeing inflation starting to outperform where the yields are at. And also people are running to gold as a safe haven. So because of that, you'll see that relationship shift over time. And that's mainly why I wanted to bring this chart out is so many people look at this and go, okay, well, this has to happen and this has to happen. Intermarket relationships, and we're all subject to it, including myself and Sam, where we do look at certain things and go, it should be this way. But I think any good technician or intermarket analyst knows things change. Look at the copper to gold ratio. That's massively gone away from the 10-year yield, and that was highly correlated with it for a long period of time.
I think really one of the biggest superpowers that doesn't get mentioned enough of technical analysis is we as technical analysts are able to change our minds much faster than someone that solely focuses on fundamental analysis because you are getting fresh data points basically 24/7 in these markets. So you're able to adjust much faster than someone that's waiting to hear from these government. I don't know. You're waiting to see what this CPI report says at the end of the month. Like imagine that being you. I could never. I'm just gonna look at crude oil, and that is what I think of CPI.
Yes, no, that's the way you should be as a trader. I think the difference is some people look at markets and it's fun. I feel like they're almost having fun just saying, "Hey, the market could end up here or it could do this." And I think that's where most people are at, and I don't think that's tradable. Like if you want to be an actual trader, you want to trade these markets, you want to make money on markets, you really have to understand that these things change. Yes, I could be very bullish on something, and then the next week I can be very bearish on that same thing. Um, so get into the next one, and then we'll bring Rick up here. He's got some stuff to do. He's got some picks from his stock picks. So looking at this one, you got gold, copper, oil, and this just screams to me what Sam and I are always talking about, which is gold rings the dinner bell on the commodity cycle. So if we're looking at commodities, basically you're looking at gold, and the way I measured it when I did the back test is breakouts. So we basically get a breakout in gold, and then it's about 1 year is the average. So it's anywhere from 10 months to 14 months, we start to see copper and oil move after that. So we did see that breakout in gold going all the way back to the end of 2023, beginning of 2024. Then copper's made a new 52-week high and tried to make a move. Oil has been lagging, but it's starting to move just a little bit. Now we really need to see it really make a move. I'd like to see it get above 80, 85. Then I would be very bullish on it. If it started to make new 52-week highs, I'd be extremely bullish on oil. At the moment, we have a trade, just a reversal trade in oil. We'll see where it ends up. But heating oil looks even better. Natural gas looks really good. But all I'm seeing, and Sam, you've talked about this a bunch, which is you go from gold, copper usually follows it next, oil follows it after that. I think on the deck we had that chart. We're seeing it, yep. Gold and copper.
Yeah, this is a great one.
So why
Yeah,
don't you explain
they
this
dance
chart, Sam?
together, I mean, just look at the 2 charts. You can see that from the early 2000s, gold really started to ascend on a brand new uptrend, and then you saw several months later, copper began a similar uptrend, and then around the Great Financial Crisis, you saw some pretty large corrections, much larger in the copper market, but nonetheless, they dance together as the main takeaway, and you can see gold carved out a multi-decade cup and handle pattern, and it resolved it on March 4th, 2024. And copper has a similar cup and handle pattern shaping up here. So I think the bet is that copper catches up to gold any day now, really. It's been almost a year since gold broke out. So you said about 10 to 14 months is the average time for copper to catch up. Yeah, I think that's not far away. So
No, I do too. And so Rick, we're gonna get to your picks in a second. You ready?
No, I'm enjoying this. Yeah.
Okay.
You
Well,
kidding me? This is grade A analysis completely for free.
well, we had the one thing I also wanted to talk about. I forgot about this one, and I clicked on it just to see, and I figured it was possibly our next chart. But Sam made this gorgeous chart. This is so good, and this is basically just talking about the relationship between copper and Chinese stocks, and the reason why that relationship exists is because China is the biggest consumer of copper on the planet. Somebody, was it Rick, was it you who said, is it because of all their fake buildings?
Might have been. I can't remember.
I know somebody was making a joke at the event. I think it was Rick, but is it because of all their fake buildings? And once again, they're buying real copper. So it's why we look at the price action over looking at what people are saying, looking at the news. They're buying real copper. Can I go to China and see what exactly they're building and account for all of it? No. But I can just see, hey, they're buying a lot of copper. That is a thing. And the price action does say that. So once again, and the correlation between their economy doing well, their stock market doing well, and copper is high. So if copper is doing good, or if China is doing good, you should think that one will do better. So looking at this chart, Sam, can you explain the correlation at the bottom?
yeah, so it's just a simple 100-day rolling correlation. So it's bounded between positive one and
Nope, I think we lost Sam.
Yeah, I was gonna say. I thought that was me for a second.
Nope.
Dude, it's the Chinese. They're coming after Sam. This chart is amazing.
Yeah. So let's go, Sam. Try to come back. Go
Yo,
out
am
and
I
come
back?
back. Oh yeah, you're back. Okay, go ahead.
He's
Sorry about
back.
that. I think that really was the Chinese there, Ricardo.
They didn't like what we were
Hey,
talking about.
trying to triangulate your position, Sam.
No, but like you look at the FXI, and I don't know, people when they first hear about Chinese stocks, they tend to think Alibaba, big tech stocks, but it's not that really. It's just China is a very pro-cyclical economy, and copper is the most pro-cyclical commodity. So they dance together. I think it's about as simple as that.
No, that's true. And just looking at it, and yeah, we're going to talk about the correlation between the copper miners and copper. I can't write back to you if you're on Twitter. Go to YouTube and I can write back to you. But just write again if you're just stuck on Twitter and just say, is it the divergence between copper miners and copper? But the thing I want to say mainly is that everybody is so bearish on China. Everybody hates China. And everybody thinks that it just can't go higher. The tariffs, the this, the that, the other thing. I mean, the thing that you learn about trading through the first Trump administration is the fact that things get backtracked quite a bit. It was the end of the world last night. The market's crashing. It's everything's over, and then the market's is the market positive right now? I haven't seen it. Can somebody write and just message me and say is the S&P up yet or not?
Yeah, last night
The-
people were freaking out,
yeah,
and copper was flat.
Yes, and
It's up now.
copper was
the
flat, and then
the
oil
Dow's
was up.
almost positive on the day. By the way, the Dow
Yep.
almost turning positive on the day. down
Oh my
9
God.
basis points. Nice reversal.
Yep. And so you got these things that you're going to see a lot during the Trump administration. You'll see the overnight market, and then you'll see him backtrack and go, "Hey, actually, the tariffs, we came to a great deal. I did a great job. I'm the best deal maker on the planet, and we flipped it all, and now we're doing good." And you're going to see that happen all the time. The big thing to me is I think everybody right now wants a reason to be bearish. Um, Whether you're on the side of him, you're not on the side of him. For me, I'm completely out of the political game. It makes it easier to trade. Um, but if you are on one side or the other, you have reasons to be bearish or bullish all the time. But it seems like overwhelmingly the people I'm talking to have so many reasons to be bearish at the moment. And once again, there's things to be concerned about. Tariffs are a concern. It's if you just told people, hey, let's run a tax on the American people, let's raise it to 20%. People would say you're nuts, but taxing our goods 20%, people are like, that's great. So looking at things like that, yeah, there's things to be concerned about. I've been writing it. At the same time, the market is in a good place. It's in an uptrend. I just think the rotation that we're seeing is going to continue. So if you look at something like Chinese stocks, that's probably a great place to probably be in. If you're looking at copper, it's probably a great place to start taking buy signals in when you get them. So just continue to kind of look for these areas that are different, and I think you'll be fine. I think looking at big tech, looking at the semiconductors, and just being like, I'm going to dump all my money into these things, I think that's a ridiculous bet at the moment. They've run a lot. I'm not saying the AI trade is done by any means. I still even have a position, but it's just one position in the whole portfolio right now. So it's, to me, it's not something where I want to focus on. I'd like to focus on these other areas that are just starting to move, starting to give buy signals, and countries like Chile and Poland. I made the joke the other day, like, the best way to seem like you're completely out of a conversation is to bring up things like, oh, what are you trading? Oh, yeah, I'm looking at Poland. Nobody cares.
I
Nobody
think
wants to
it
look at
comes down
Poland or
to
Chile.
sector rotation is the lifeblood of a bull market. And
Absolutely.
we've seen Nvidia 10x over the last several years during this bull market. To bet on Nvidia being another 10x from here is a lot harder than buying Chinese tech stocks and betting on those 10xing from here. So I think
Yes.
that's really what the market is um, doing right now.
And if you look at that, let's take that a step further, because that conversation comes up a lot when it comes to Bitcoin. People look at Bitcoin and they go, "Oh, it could go up to 1 million here. It could go up to 2 million here." Um, and sure, I'm not saying anything's possible, but when you have when Bitcoin was making those 20, 30x moves, the market cap wasn't even $1 billion, and then it gets over 1 billion, it hits 100 billion, and we got a huge move up to that 20,000 level. Now at the market cap level it's at today, for it to just go 10x, I'm not saying it can't 10x in a few years, but saying it's going to 10x, this year, by the end of the year we'll hit 1 million and stuff like that. It's going to be hard to do. I'm not saying, I still have a position, I'm long it, but I still think that there's better things to continue to look at, continue to look at other areas, have your positions in the things that are in uptrends, but also there's these other areas emerging that you're going to want to look to. So any tickers you prefer for metals, miners, etc.? Okay, so we got a question about the divergence in copper miners. And so I'm not sure exactly, because it's something that I use the ETFs. So Sam, do you know what copper miner? I mean, or we could look at CopX, obviously. So what else should we look at for this sector?
I think SCCO, Southern Copper,
Southern
is
Copper.
that is the best copper miner. That is, I believe, that is Peruvian. My data is telling
Yeah,
me it's
no, it is.
headquartered in Phoenix, Arizona, but
It's
I
so
don't
the
think they're
mines are in
mining
Peru.
copper in Phoenix.
The mines are in Peru, for that
Gotcha.
one. So Southern Copper, the mines are in Peru, which is why it's in the Peru ETF. So CopX versus copper. So we'll look at CopX versus copper. So, but yeah, I know they're lagging. So, and once again, it's something that you're just going to see over time.
We were just talking about this with gold and gold miners, and that gold it broke out almost a year ago at this point, and you haven't seen much participation from gold miners at an index level. That's not to say there aren't individual components that have had tremendous returns over that time frame, but it takes time for these institutions to really pick up onto these themes, and I think it reiterates that we're early in this cycle. Copper hasn't even broken out yet, so to expect copper miners to break out, I think, is kind of premature.
No, that's a good point. When you're looking at these, it's the way I look at these relationships, and the reason why I even look at them in the first place is to for risk on, risk off. So for me, I'm always using the ETFs mainly. Individual stocks with all the other things in trading kind of gets rough for me to pay attention to everything. So COPX to copper is something that I would look at quite a bit. So right now the COPX line is black, the copper line is yellow. So if we're looking at that, you're going to just kind of look for this for risk on periods. What you see when the copper miners are really outperforming, that's a risk on period. Most of the time, the underlying metal does really well in those periods as well. But the thing that's going to make you the most money is going to be the copper miners, depending on what you're doing. If you're just buying, no leverage ETF in CPER, CPER, or if you're buying, just the copper thing with no leverage in futures, of course you're going to run into those situations where it does underperform. If you're using futures, you're using leverage, that outperformance will be there in the actual futures. But just looking at this, for me, it's kind of like, hey, is this a time to really, I want to buy the copper miners? You could try to do that type of catch up trade. It's not my style. But what I would wait for is really, in the copper miners, I'd want to see some momentum behind this move, and we're just not seeing any yet. To get above, at least four. If you're going to wait for anything, it's at least 40.62. At the very least 40.62. I wouldn't touch it until it hits that level. You could possibly run like a half position there, start to add to the position. When you get above 43.35. For me, there's just no signals to really touch these just yet. But also that kind of scares me a little bit about the copper trade so far. Not saying I'm against it. We're long it in our reversal model, but I am saying it's a situation where you might not want to touch it too soon because this doesn't look very constructive just yet. But I think it will look more constructive if we're looking at China and we're looking at copper and they're both moving. There's no reason the copper miners won't catch up. But I'm not seeing that even from FCX, right? FCX kind of looks similar. Yeah. So
I think
they're all looking similar.
SCCO is the best looking one,
Yeah.
without a doubt.
It still has you did a paper on that recently, Sam. Does it still have relative strength?
Oh, for sure, yeah.
Yeah. So it still has
And the
relative
thing about
strength.
these miners is it's much like gold miners that you have good operators and you have bad operators. Who was it that said that a gold mine is just a CEO standing next to a hole in the ground, something like that?
Yeah, yeah. And it's well said and it's true. It's just and that's what you're going to see at the end of these cycles. You'll see that a ton at the end of the cycles. At the beginning of cycles, you'll see things like this. We'll be looking at Southern Copper and we'll all say, yeah, that chart looks like crap. And it's probably going to, if copper continues to move and gold and all the metals continue to move, this thing will probably be the outperformer.
For sure. It's already broken out above the prior cycle high. I think that is the most important thing to note with this chart. I mean, that in itself is relative strength, and there's not another chart that looks like this. So when you see these copper miners and copper really start to get some momentum, then I think that one's front and center.
Yeah, Rick mentioned this, which is you said this is equally weighted, Rick, or COPX is equally weighted.
Yeah, so someone was asking in the chat why the divergence between COPX and COPP. COPP is cap weighted, whereas COPX is equally weighted. So you're going to get an outsized weighting and stuff like Freeport in a COPP, whereas COPX, everything's weighted equally. Seems
Nice.
to be the major reason why they're divergent.
So, and one more question. So, and this is very interesting. So we'll get back to this type of chart, which is he said basket of commodities to buy now and hold for 1 year. Already have gold. So first thing, we can't give recommendations on here. So we're not supposed to give recommendations on what you should buy or sell. But I can tell you what I'm doing. One is if you're going to buy commodities, you want to run a trend model, some sort of thing that's going to tell you when to get in and out. You're not really trading if you don't have a way to get in and out. And saying 1 year, the fundamentals could change, the year could change. Who knows if we end up in a recession by that time or a depression, and then the price of oil just falls, off of a cliff. I think that's probably not going to happen. But once again, the fundamentals can always change. The technicals can always change. So looking at this at the moment, I would say, what am I long? What do I not want to be involved in? So right now, I'm long coffee, I'm long silver, I'm long natural gas. Platinum is getting very close to a buy signal, and Sam likes platinum. Long heating oil, gold. You said you're long gold as well. That's awesome. But I think a lot of people aren't looking at the grains either right now, which the grains could be the big separator. Looking at corn, looking at soybeans. Lumber is a great one. I know nobody trades it because it's a futures only product, but you can take a look at that. Cattle's been holding up pretty well. So there's a bunch of areas to look at. Very simple. Can you put a trade on if you're trading futures? Run trend models. If you're just buying for like in the long term and you want to have some commodities exposure, ETFs like DBA are great. That's the agricultural ETF. It holds a basket of commodities. Or you could look at something like DBC. This also holds a basket of commodities from energy, and it's that one's mainly energy based. So try to think of it that way. That one's going to be more energy based. DBA is going to be more agricultural based. You guys have any additions on that?
I think you nailed it, but for me, DBA is much, much, much more interesting. Look at these
Mm-hmm.
moves we've seen in coffee, in cocoa, in orange juice. These soft commodities are popping off. And you look at something like crude oil, it's just done absolutely nothing for quite some time now. So I don't really want a whole lot of exposure to that at the moment. I really wanted to lean into the relative strength of the soft commodities.
All right, let me get to the Rick's picks. So Rick, what slide were you on, Rick?
We're ready,
26.
man. Let's do slide 26. I have a few things I want to talk about. Keeping it very commodity centric, yes, but bringing in a little bit of equities as well into the mix. And this chart comes from TradeWave AI from our friend Afshin,
Nice.
Jason. So this is looking at S&P 500 and Dow Jones Industrials seasonality for the first year after a presidential election. So it's a lot of chop, right? That's the main takeaway. What's the only takeaway? I mean, chop. Really, that's it. And so when we see things like the tariffs or whatever the earnings were, and the market's just kind of not making its mind whether it wants to go up, whether it wants to go down, and it just continues to chop sideways, that is nothing new. That is nothing out of the ordinary. So that's just something I want to bring up, and it doesn't make it less frustrating, right? I mean, the
Yeah.
fact that markets are expected to chop doesn't make it less frustrating that you put a trade on, you get stopped out, or vice versa. You put a short on and then get stopped out. Anyway, that's the first chart I wanted to bring up, and I wanted to bring up the second one, which is in our country tracking model, Jason.
Mm-hmm.
UAE and Saudi Arabia really stand out. UAE, this is sorted by proximity to new 100-day highs, and UAE is on top of that list. And if you look at a chart of Saudi Arabia, which I didn't bring with me, but it just looks like a textbook symmetrical triangle, right? A little coil, and it's getting really tight in there. So two Gulf states, very heavily weighted in the energy, as far as their economy, their markets as well. And they both look one of them is already going, and one of them looks damn near ready to go, and the reversal base is almost in. So looking at those two, and then you
Yeah,
see
and I
stuff
look
like
and I look crazy all the time, Rick, because I've had a Saudi Arabia position that hasn't been stopped out or gone up for, I think it's like 6 months or a year or something. You can see all that chop basically there. So this position gave a buy signal last year, and then it's basically chopped around the rest of the year. It's done nothing, but it's still in the portfolio, and like Rick said, there's a lot of reasons to be excited about it, thinking that it can move higher. And our model here showing it is actually it's back into an uptrend. It looks very good. It's set up, so I think it's an area that you're going to want to continue to look at, especially if you guys are people who look into the commodity space and you want to be in commodity countries, commodity based sectors. It doesn't sound sexy to trade sectors. It's not like, hey, I'm going to buy Apple and I have the phone and we're going to do this tomorrow. It's just, hey, I'm buying Saudi Arabia. Sounds boring. However, you're talking about the biggest oil company on the planet. You're talking about commodity exposure, and so you're going to want to continue to take a look at that.
I'm gonna be honest, man. I have to disagree with you. I think it sounds extremely cool when you say, "Yeah, I just bought Saudi Arabia and UAE." I think that sounds pretty sick.
Agreed.
Well, what we do on here, Rick, yes, us three, we
Yeah,
we definitely think it's
yeah.
awesome to own things like that. But once again, most of the people they could care less.
I get it, man.
But it's
Listen,
where the money's made.
trailing 3 months, S&P is down to flat.
Mhm.
Saudi Arabia is actually up 2%. UAE is up 11%. So if UAE is any indication as to where sort of the Gulf states are going to go, I think
Mhm.
Saudi Arabia could be next easily. And I think we can move on to the next one. This is Bitcoin, a spot Bitcoin, not Bitcoin futures.
Look at that
And
pretty chart. That's a nice chart.
look at that, man. Listen, I woke up and I know JC was talking about how I think his grandmother is a contrarian indicator, Sean's wife, and other folks on the All Star Charts team. I have my contrarian indicator as well. It's a guy went to school, very smart guy, wants to sound very smart all the time. It's one of these like big brain macro guys who's panicking. The market's gonna crash. I wish I could buy puts in the pre-market. This kind of stuff. Listen, as long as Bitcoin is above the election anchored VWAPs, I'm not scared at all. I'm not selling anything. I think that's a pretty clean level to define risk at. I mean, a lot of volume came into the crypto markets after the election. We saw that huge rally, especially down the camp scale stuff like Doge, Solana, obviously, XRP. But looking at Bitcoin, which is really like I don't know if we want to call it the bellwether, but it's the biggest by far, the one that gets the most
Mhm.
attention, the one that everyone knows, and probably the one that's going to be around for the longest. Famous last words, maybe, but it's that's what it seems like. Above it, as long as we're above these levels, I'm not very concerned, man. I
I
don't know
love
what you
this
guys
chart.
think of this.
I love this chart. Look. So what's funny is before like literally 5 minutes before I went to bed last night, I get Bitcoin hit the bottom of the implied move. And once again, I don't look at the markets on the weekend much, but I have an ad signal thing, and the ad signal basically is like, "Go buy Bitcoin," and I like open up the fucking markets at night, and I'm like, "Oh." The Bitcoin was down like what, like 10% over. It was 12%. It's 12% overnight, and you get an
Listen,
ad
I
signal,
thought
you know.
Yeah, I saw, across my feed, record liquidations. I know everyone got fucking killed because everyone was over levered. I think it was genuinely like the record day for liquidations yesterday as far as cryptocurrencies, maybe just Bitcoin. And maybe that's the last shakeout we needed before the big rip. I'm not too sure. I mean, we just saw a chart of seasonality, although I think Bitcoin maybe might act as a leading indicator.
And
And
isn't
looking at the
February the best month of the year
For
Yes,
Bitcoin, yep,
yes. I,
yep.
I was about to, yes. So who
Sorry, I was
knows?
Damn,
Maybe
Sam.
this is the, no, no, no. I mean, that's something I learned from you, Sam. So
I'm just kidding.
it's only right you bring it up, dude. Like, listen, I could see some situation where this is the last shakeout. We see maybe a little bit of ranging, a little bit of basing accumulation above this level. Then Bitcoin rips higher, climbing that so-called wall of worry while everyone else is still concerned about the tariffs, the market's going to crash, you name it. I could see that scenario play out. And
No, I
that's all I
love
have to say
this.
for this chart. I have another one, and I made this next chart because you guys were talking about copper. I'm like, oh, I love my long-term Fibonacci levels. So
You
let's
weirdo.
look at the long-term Fibonacci extensions in copper futures. And guess what? Guess what? The 4.5 level, it's very important because number one, it's a shelf of former highs, but also there's a long-term fib extension level, and we are coiling at that level. So looking at, just very long-term cycle moves, this could be, like Sam was saying, the beginning of the cycle. Right? And
So
this is
over
consistent with,
4.56, you're very bullish on that move then.
yes, sir. Yes.
Yeah.
So it's coincides with a lot of former highs. The late 2000s cycle high is sitting around that exact same level, and the 22, 21 high as well as the pivot highs from early last year. I mean, I think there's still a lot of money to be made in copper.
I do
These are just,
too.
yeah, man. I mean, again, above that level, if you're looking for something to define risk at, if you don't have, say, a system that's going to give you buy or sell signals, that's a good level as any. Long above 4.5 or 456. Below that, you don't want to touch it because it's messy, it's ranging, it's coiling. Yeah, that's it. And the next chart, you're gonna fucking love this chart. And again, this is another thing I stole from Sam. All nice things are
Damn,
stolen
dude.
from Sam Gatlin. The chart Sam shared in the analyst group chat at All Star many months ago, anchoring a VWAP to the 2020 lows in crude oil. Right, looking at
The
the
price went
front month,
negative, so it just seemed to me like a
dude. It is.
pretty decent time to anchor a VWAP.
Oh
Listen,
yeah.
Sam, it's been the level, and we are back above that level for the first time in many months. We're sort of coiling below a key low back in early 23 and the VWAP anchored to the 2020 lows, and you just coiled above that. You broke above that, obviously. And then on the, this looks like a textbook shortfall. I don't know how fresh you folks are on your TA, but a shortfall is essentially when you make a slightly higher low in a set range. It's also just called kind of you can also just call it like a retest, but it's something you get before a retest. So that's kind of what this looks like to me, right? You have your key range, that little coil, um, all of last year, and you're bouncing back above that coil, which coincides with the VWAP anchor from the 2020 low. So I mean, if this level holds, I think oil could go a lot higher from here, but we need this level to hold. If not, it's still back. It's back in that range. It's messy. I don't want to touch it if it's under that level. I don't know what you guys think. I think that's a clean level, man.
No, that is definitely a clean level, and just going back to last year, that super tight coil we had going on. The Bears had their opportunity to break this thing down, and they failed miserably. And first thing this year, the Bulls came out and ripped this thing higher. So seems to
Yeah,
me like
and
the market
then
is spoken.
yeah, listen, I have a few more charts, and this is we can just rapid fire through them. Next
Okay, we
chart
got
is
we got
Comstock.
only a couple minutes left because Sam and I got another video, but and I got to figure out what the hell's going on with my camera.
That's
But
fine, man. We
I
can rapid
shared
fire.
we're gonna do a rapid fire, but for everybody who wants to check out more on this commodities cycle, I just wrote a big report on it. I just made it free. So it's on my page on Twitter. It's in the description on YouTube. I put it in the comments on YouTube as well. So make sure to subscribe, follow, turn on your notifications because subscribing doesn't really work on YouTube anymore. So you got to put on your notifications. Hit that notification bell. So let's jump into it, Rick.
Yeah, so I brought you Comstock 6-7 points ago. It's at 20. It's at 19 now, but it's a completely different trade now than it was back 2 months ago, a month and a half ago. Completely different trade because now you got the 22 level. It's coming into play, and I wanted to find. I'm treating it as a completely new trade now. So 22 above that level, you want to be long. Look at that base. That's a decade long base. Nice little cup and handle action as well. And maybe you get a little basing action. Maybe you get a little consolidation below the 22 level. We already failed to break through. earlier this year. So it would make sense to maybe get a little flag, but who knows? That's all speculation. All I want to say is above 22, you want to be long this name. Not financial advice. Obviously, I'm already long, but quick little way to make money in the natty gas. AEM, right? This is one of Sam's favorite names, and for a reason, right? It's one of the best performing gold miners. And again, we're at two key levels, right? A shelf of former highs, which coincides with a key fib extension levels, and we're targeting above 85, 89 range. Gives us a nice little range to define risk at. You want to target 130 to 137, just roughly. And I have a few more. We can maybe just skip. 3M is an interesting one. It's the next chart over. 3M, MMM, which is Minnesota Metals and Mining, Sam. I think that's what it is. Anyway,
Yeah, I did not know that.
we're above the all-time high anchor VWAP. Again, this used to be a bellwether. This used to be an absolute juggernaut in the industrial space, and then it just ceased to be. Then they suspended the dividend roughly a year ago, right? Maybe less. I think it was roughly a year ago, and it just ripped higher. It was coiling there for a bit, broke out. So it's not bearish at all to see something like a 3M that underperformed for the longest time, right? That's like 5, 6 years of underperformance, massive underperformance. So seeing a name like 3M come back, this chart almost reminds me like a mini GE, to where you can see the cycles, and it's just a long downtrend, and then you start to turn around. You're above the 38 too. You're above the all-time high VWAP. You're approaching 161, which is another clean level you can define your risk at for a long. And yeah, that's all I have for trades. And I have two more charts that we can just show because I think they're pretty cool. Because I saw you guys were talking about
This
Palladium,
is
so
the
I just brought
Bartoloni
this chart.
special right here.
Listen, Palladium futures Nasdaq used to be a lot more correlated, man. I mean, listen, is there a catch-up trade in Palladium futures? Maybe. I mean,
It's so tough because for me, it's like I used to look at this correlation so much when I first started trading, and I would be like, "Oh, it's makes sense. It's this," because back in the 90s, if you looked at
hardware,
this,
right?
it was literal. Yeah, it had some hardware. It was all of these things kind of made, but once again, silver didn't go anywhere, and all these other things didn't go anywhere, but palladium did. But now going forward, it's like, what exactly is the correlation? And once again, I don't care. And that's the other thing that I
Yeah.
have to say. I don't care if the correlation exists and there's nothing to make it fundamentally make sense. As long as it exists, it makes sense. But now it's really out of play. And then I don't see the reason for it to do a catch-up trade besides the fact that, once again, think about it this way. If palladium just starts to go up here, do we think that's an environment where technology is just going to rip too? Or is it an environment where palladium's ripping, the commodities are ripping because they're ripping, inflation is, and yields are making multiples go higher in some of these big tech names, and then we're in a situation where palladium is ripping, and then
That's a
technology is
very
moving down.
interesting. That would be a very interesting scenario. I mean, I think the Qs aren't the worst inflation hedge, but yeah, it would be a very interesting scenario. I guess we'll see if we get there, and we'll bring this chart back up, and we can
Stocks
sort
are
of
stocks are a good inflation hedge, and I think that's something that when in 2020 happened, a lot of people like me who are commodities guys never say that. But if you look over time, the things that got killed the most, bonds get killed the most in an inflationary environment.
yeah.
So like I'd rather see people, especially the retirement people in the retirement community. I've talked to people about this. They always think I'm crazy, but I'm like, hey, it's actually because you talk to a financial advisor. What's the risky portfolio? Well, it's more stocks. Well, actually, in this environment, the risky portfolio is more bonds. This type of environment, you wouldn't want to go 40% bonds, 60% stocks. You'd want to do it the opposite way, or even more. You'd want to go very short dated bonds, maybe 10, 20% of your portfolio if you need to be diversified for some reason. A lot of financial advisors do. And then you'd want to go 80 to 90% stocks. And that would be safer for you than just going straight into hey, I'm gonna 40% bonds because I've been doing it for the last 40 years.
Yeah, no, that's a bad strategy right there. 60-40's gotten. I mean, there's been so many articles written about that in the past,
And
year or two.
nobody
How the
cares.
60-40. Yeah, that's true, man. This is the last chart I wanted to bring on, and it's looking at the relationship between smalls and large, looking at S&P 600 versus Dow Jones Industrials. And on the bottom pane, I'm looking at Russell versus Dow Jones Industrials. If you don't know what the difference is between the Russell or the S&P 600, I'm not speaking to you, Jason, because I know you know. I'm speaking to the someone out there who might not know. It's basically S&P requires some earnings history for these companies, whereas Russell does not. So Russell just lets just about anyone in, whereas S&P doesn't. So over time, S&P is going to look a little better than the Russell, just because it's going to have slightly better companies in there in the makeup, and that's going to compound over time slightly, right? Few percentages here and there, but it does add up. So on the bottom pane, I'm looking at the Russell, which is weaker over the Dow, and it just looks like an oscillator to me. I really stood out because I was like, oh, what does S&P 600 versus Dow look like? Looks similar, but very different. Now, if we look at the Russell, when it's at that lower end of the range, the Russell Dow, and S&P 600 versus, again, Dow, it's been in a secular downtrend for many years now. This is as good a time as any. The reason why I'm bringing this chart up, this is a good a time as any. The environment's a little confusing right now. Things work and then they stop working the next week. You get signals and you get the counter signal. Listen, I get it. But this is as good a time as any for smalls to start outperforming once more. And it would be very welcome, right? As far as rotation, to get rotation into the mid space. I know I wouldn't complain. Obviously, you play with what the market gives you, not what you want the market to give you, but it's just something to keep an eye on. It's just these smalls and these relationships.
Great place to end it. One more very important question for you, Rick. Why is
Yes,
a
man.
dinosaur on the chart?
That's not my doing, my friend. That is trading view. That just means the data doesn't go
Oh, yeah,
past
yeah.
that.
Okay. I didn't
It
think it
just
was a
means like,
trading view chart for a second, but I see it at the bottom now. Okay.
yeah,
I thought it was
just
an
means
Optima.
oh no. You know me and Optima are we don't see eye to eye.
Nobody does. But hey, we can't talk about that here. Anyways, hope you guys had a
Thanks for
great
bringing me
time.
on.
Yeah, of course, man. Thanks for coming on, Rick. Sam, as always, awesome to have you. We're on every week at 11 a.m. on Mondays. Sam and I now are going to go hop onto the Gold Rush. So if you're a subscriber to Gold Rush, you guys are going to see that as well. Got some big charts to talk to you guys about. See you in a second.
Goodbye, everybody.